Have you ever bought or sold options and wondered, what do I do now? And when do I exit the trade? If you've ever browsed the internet to learn about options trading, you've almost certainly encountered horror stories of people seeing their accounts experience significant profits, only to lose them a couple of days later. I mean, a 99% loss in someone's account is certainly possible in options trading, but I guess you could say that about any speculative investment. I mean, look at this guy who claims to have lost $414,000 in one day. And that's why having an exit strategy for every trade you start is important. This is especially important when you're trading options, since you might experience significant losses if you don't have a strategy in place to lock in profits and limit losses. By the way, if you're new to the channel, my name is Rick Orford, author of The Financially Independent Millennial. I'm a Wall Street Journal best-selling author, and I've been trading stocks and options since 1999. My gosh, time flies when you're having fun, right? Today, I talk about stocks and options trading, and my work is regularly published on NASDAQ, Yahoo Finance, Business Insider, and major newspapers. So you can trust that I know what I'm talking about. Of course, you can Google me to see what comes up. That said, I do have a little disclaimer. I'm not a licensed financial or investment advisor, and anything we talk about in this channel or in this video is not financial advice. If you're thinking of putting anything that you've learned from this video into action, I always recommend consulting with an investment advisor first. That said, I'm sure you're going to learn a lot about the exit strategies for options trading that I use, so stick around to the end. And of course, if you like the content or learned something important, I invite you to subscribe to the channel so that you don't miss any future videos in this series. Okay, so with that out of the way, today we're going to be discussing exit strategies for options trades. And by the way, I broke up the video into chapters so that in case you're familiar with whatever it is that I'm talking about in that chapter, you can go ahead and skip ahead. Okay, so let's get right on into it, starting with what are options. Options are directional bets using underlying securities as a basis. And there's two types of options, calls and puts, and two ways to trade them, buying them or selling them. Call options give the holder the right, but not the obligation to buy stock at a specific price at any time before expiration. And folks buy call options and pay a premium that's based on the strike price and expiration date. Now, put options are the exact reverse. They give the holder the right but not the obligation to sell stock or an underlying security at any time before expiration. And like call options, investors will pay a premium to buy them. Now, if you sell an option, you're said to be short. Like, you can be short a call or a put, and you get paid by the buyer to take on the responsibility to either buy or sell the underlying security should the holder decide. And that's what's called assignment. And that's the main risk that you face with selling options, assignment risk. Now, statistically, there is a very small chance that options will get assigned before expiration. Actually, it's only 7% to be exact, according to FINRA. Now, a small chance does not mean zero. Remember, in American-style options, option buyers can exercise their options at any time before expiration and for any reason, even if it doesn't make sense. So if you have a short put on a stock, for example, that has a $200 strike, that means you'd have to pay $20,000 plus any trading fees if your option gets assigned, because one options contract equals 100 shares of the underlying security. Now, option sellers typically close their positions before expiration to avoid assignment, which is one of the main reasons why only 7% of options are assigned. But how does one go about exiting an options trade, and what do you need to do to ensure that you can still walk away with profits? Well, for that, we're going to start with a hypothetical trade. When you buy an option, you create what's called a positive position. So it's reflected as a +1 in your brokerage account. Just like if you were to short a stock, when you sell an option, you create a negative position or a -1. So to close out a short position, you would need to buy another, a +1, to turn your overall position to 0. You can enter a buy to close order in your trading platform to buy back the option you sold, and that closes your trade. And of course, if you are long an option, well, then what you'd issue a sell to close order, again for the same underlying security, strike price, and expiration date to close it out. It's really that easy. Now, let's imagine for a moment that you sold a put option. If you decide to close it out, you'll issue a buy to close order, and now you're going to need to pay a premium. And let me express this in a hypothetical trade. Let's say you wrote a put option on Tesla with a $150 strike that will expire in 2 weeks. And for that, let's say you received $2.86 in premium, or $286 total for the contract. And let's say Tesla is trading at $160 at the time you wrote your put. Your break-even price for this trade is $147.14. Now, if you want to keep that premium, in the next chapter, we're going to discuss my 80-20 rule in options trading. With the 80-20 rule, you're going to want to take profits when you can get 80% of your target. Now, on a long option, it's a little bit more different because you're going to have to define the profit zone that you'd like. But if you have a short position, I like to close it out when I can buy it back for 20% of the initial premium. So what does that mean? Say you sold an option and collected $100 in premium. Well, if the premium hit $20, the option lost 80% of its value, well, you can now buy it back for 20 cents on the dollar and you get to keep the 80 bucks. Now, if you have a bunch of options trades, it means that you need to monitor your position closely, and when the opportunity to buy back your short option for 20% of your premium comes in, I say take it. And if we go back to the previous example of Tesla, say it's 10 days later, and now you see Tesla is trading at $150, and the $150 strike put options are now trading for 57 cents a share. Well, you could enter a buy to close order for your $150 strike short put, and you'll have to pay 57 cents. And that means we'll subtract 57 cents from your original $2.86 premium, making your total profit $2.29, or $229 on the trade. And that profit is crystallized then and there. Now, if you're long a call or a put, in this case, you'll be speculating in a particular direction. For example, if you buy a call option on Apple, that means you're bullish on Apple and expect or hope that it lands above the strike price at or by expiration. But if at the onset of the trade, let's say you say, I'm happy with $100 of profit or $200 on this trade, then by being a disciplined investor, if you have the chance to sell it for $100 or $200 more than you paid, then do it and move on. But what about the losses? As I said, I've been investing in stocks and options since 1999. And there's one thing that I've come to realize, that exits, both profits and losses, should always be defined at the onset of the trade. So this works for stocks, options, crypto, or any type of investment instrument or derivative. Now, setting up your stop loss gives you some control over how much you can lose on the trade. Let's say, for example, we use the previous Tesla example again, right? You collected $286 in premium for the $150 short strike put. Your break-even price is $147.14. Now, short put losses can get bigger and bigger as the underlying stock moves below the break-even price. So let's say you decide to cap your losses at, let's say, $150 total. To get the stop loss price, what you're going to do is you're going to subtract $1.50 from your break-even price. And for that, you're going to get $145.64. And that's your stop loss price. You can also apply the 80-20 rule to that stop loss. Just multiply your stop by 80%, and you can set it to $116.52. And stop losses can be typically set up at any time, and they can state that they're good until canceled. However, enforcing stop losses unfortunately isn't easy as setting them up. So there's a psychological element to it. I know traders who set stop losses at the onset of the trade, but then cancel them because they believe that the trade might still work out in their favor, even if everything points to something of the opposite, right? There's a certain element of FOMO, right? Fear of missing out when this happens. Now, setting and enforcing stop losses requires discipline, and so does taking those chips off the table when it's the right time. But what if there's a way that we can combine the two, a stop loss order and a profit taking order? A bracket order allows you to combine both a stop loss and a profit taking order when you buy or sell your option. Bracket orders are entered at the start of the trade, setting limits for both the profit and the loss in one swoop. And I suggest that traders take advantage of this feature whenever possible, as it takes most of the guesswork out of the trade. Now, this is a more advanced feature, and both brokerages like Interactive Brokers and Thinkorswim offers it, and I'll leave a link in the description below for how to enter those trades. And perhaps other brokerages have them as well, but these are the ones that I know. But I absolutely can't stress it enough. Set your profit and loss orders when you start any trade and stick to it, and you'll be able to sleep better at night knowing that your profits and losses will have some element of certainty. That said, I need you to know that stop loss orders trigger a market order once the security hits a certain point. So let's say your stop loss is $150 and the trade moves below $150. Well, in this case, a market order is going to be placed, meaning that you may get less than $150, especially if the market is moving down fast. But you'd probably be better off than if you waited to react. And of course, like I said earlier, if you want to use the 80-20 rule and want to limit losses on the trade to, say, $150, well, you could be a little bit more conservative and set a stop at 80%, which is $120. And if and when it triggers, you'll have an even better chance of not losing that full $150 or more. Now, what can you do if you haven't already set up a bracket order? Another way to take advantage of buying and selling options is by rolling the trade's expiration date or strike price. Just like with closing the trade, you're going to have to buy or sell to close. Now, if you're long an option and it became profitable, you can sell it at a profit, and then you can buy another option with a different expiration or strike price. And this is actually quite common in investing, especially with cash-settled derivatives like in futures trading. Now, by rolling your expiration date forward, you give your trade more time to play out the way you want. Now, if you're short an option and the trade is going the wrong way, well, you can always buy it back. And yes, it might cost you more than the premium that you collected, but then you can sell another one with a different expiration date and strike price to offset those interim losses. And that's what rolling the trade is. Another way to protect yourself from losses when using short options is by creating a credit spread. To do this with a short put, you need to buy a put option to create what's called a bull put spread. Again, let's use our handy Tesla short put example where you collected $2.86 a share or $286 in premium at the $150 strike price. And to make this trade a bull put spread, you can buy to open a Tesla long put with, let's say, $145 strike price for $1.50, for example, with the same expiration date. So your maximum is now $1.36, and we will calculate that by taking the premium received and subtracting the premium paid. Now, your maximum loss is limited to the difference between the strike prices less the premium received, or in this case, it's $364 per contract. And if you're wondering, the break-even price on a put credit spread is calculated by taking the short put strike and subtracting the net premium received, which works out to $148.64. Remember, the break-even price is the point where your trade starts to lose money. So in this case, you want the stock to stay above that price. But what if you originally sold a call option? Now, if you happen to sell a naked call for whatever reason, maybe you made a mistake, and by the way, I would never suggest you to ever sell a naked call because it's quite possibly the riskiest trade out there. A naked call has unlimited risk. However, let's say you did. Well, you could limit the risk by converting your naked call into a call credit spread, also known as a bear call spread. And all you need to do is buy a call option on the underlying security at a higher strike price than the one you sold, and of course at the same expiration date. And these two strategies, well, they deserve their own video, right? And thankfully, I have one right up here if you want to learn more about it. Now, there are many ways to exit an options trade to lock in profits and avoid potentially massive losses should the underlying position move against you. And if there's just two things to pick up from this video, make them these. One, always define your stop loss and profit-taking levels and set them up before the trade. And two, take the profits when you get to 80% of what you'd hope. So that's it for this video. Do you have any questions? Tell me about your exit strategies in the comments below. Let's keep the engagement going. Thank you so much for watching, and I'll see you in my next video. Bye.